Hi there, welcome back. This is the E.M.I for the month of July 2026. Let's jump right in. In this month's E.M.I, as usual, we make a number of observations. We see how crude's drop trickled into three asset classes: debt, gold, and equities. We notice that GST collections saw a pickup, balance of payments saw improvement, and agricultural exports moved higher. Geopolitical uncertainties eased and saw ceasefires between Iran and Israel US before they appeared fragile. We take a quick peek into global domestic returns, flows, market outperformance, mid small cap spreads over large cap, and much more. On investing, we see how nominal portfolios change if one adjusts for tax and inflation. We also calculate what a pre-tax, pre-inflation retirement corpus would look like. Three assets to keep an eye out for in July: India 10-year yields, gold prices, and India US equities. India's 10-year yields share a close relationship with crude price movement. Last month's sharp drop in crude led to 10-year yields ease nearly 35 basis points, continuing the moderation it started mid-May 2026. If one assumes crude pressure is out of the way and also a manageable monsoon, the question markets could revisit are RBI rate cuts, the quantum, and even the question if the RBI might hike at all. We now move to the short rally witnessed in the dollar index that began end January 2026 when US President announced a perceived hawk, Mr. Kevin Warsh, as the Fed chair nominee. Gold prices reacted immediately and commodity exchanges reacted with higher margins that led to the second leg of price drop. What followed were crude price rises due to the Hormuz conflict and increased market expectations that the Federal Reserve would have to turn hawkish to address inflationary expectations. Recent commentary from the Fed has been softer than expected, leading to dollar softness. Markets, therefore, would keep an eye out for the end July 2026 Federal Reserve policy for any rate softening narratives that could in turn lend some strength to gold. Elevated crude prices were one of the key headwinds for Indian equities after US tariffs. Easing crude prices bring focus back to India that outperformed US in relative terms in June. Early last month, we wrote that markets would eventually focus on a deconcentration trade and recorded an E.M.I on the same as well. June's chip and tech sell-off appears to have brought this very narrative in focus. Let's now take a quick look at how some key short frequency macro indicators look like. GST picked up on IGST, while West Asia disruptions impacted trade. Balance of payments improved, and one should expect RBI's measures to help this further. Two-wheeler tractor sales normalized, and agricultural exports saw a pickup. Credit growth remained strong, and dollar strength gave gold some weakness. Let us now shift to the markets. Before we look at returns and valuations, let's see how the Nifty performed in June. Nifty delivered 1.4% positive returns in rupee terms for the month of June. Banks, realty, media were top outperformers, while IT, metals, commodities were key underperformers. On cap curves, small cap outperformed the BSE 500, followed by Nifty and mid caps. Japan, India outperformed key equity markets in June in US dollar terms. Drilling further down emerging markets, Philippines and India seem to have outperformed most emerging and developed markets in June. MSCI India in US dollar terms appears to be holding up just above MSCI European Union and MSCI emerging market indices. Markets saw a sharp rebound in FII debt inflows in June. Metals and mining and capital goods showed flows holding up on a 12-month trailing basis. Remember here that data in this chart is as of mid-June 2026, and the second half of June saw markets pick up appreciably in equity flows as crude prices eased alongside a drop in rupee volatility due to RBI actions. China's outperformance over India started waning sharply in the month of June. Valuations remained mixed in June with a marginal small cap pickup. Mid and small cap spreads over large cap remained positive and range bound. Now we come to the last segment of E.M.I. What must you know before investing? How do nominal portfolios change if one adjusts for tax and inflation? Let's look at one scenario. Target investment for a post-tax retirement sum of rupees 1 crore. Investing a lump sum of 1.1 lakhs at 20 years of age at 12% investment CAGR delivers rupees 1 crore worth pre-tax, and this drops to 70.3 lakhs post-tax, assuming 30% tax rate. To receive exactly rupees 1 crore on retirement post-tax, the lump sum investment needed at 20 years has to be increased by 36% to 1.5 lakhs. Now let us look at a second scenario. Target investment for a post-inflation retirement sum of rupees 1 crore. Investing a lump sum of rupees 1.1 lakhs at 20 years of age at 12% investment CAGR delivers 1 crore worth of pre-inflation and drops to 9.7 lakhs post-tax, assuming 6% inflation. To receive exactly rupees 1 crore on retirement post-inflation, the lump sum investment needed at 20 years of age needs to be upped 10x to rupees 11.1 lakhs. Now let's combine both the scenarios into one. What will a pre-tax, pre-inflation retirement corpus look like? Let us target a post-tax, post-inflation retirement corpus of rupees 1 crore. If one were to target receiving today's equivalent of rupees 1 crore on retirement at 60 years of age, the investment amount needed at 20 years of age would have to be higher by 14.4x to rupees 15.8 lakhs. Till next time, this is Arjun signing off.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.